In a famous American experiment, researchers pitted elite chartered accountants against a group of 10-year-old children in a stock-picking contest. Years later, when the returns were compared, the children hadn't just competed, they had significantly outperformed the professionals. This raises a difficult question. How is it mathematically possible for children with no financial training to beat the most sophisticated minds in the industry? Most of us are taught to view the stock market as a dangerous, unpredictable environment. In many households, it's spoken of as a guaranteed path to ruin, a sentiment that discourages millions from ever participating. This fear creates a strange contradiction. We will hold physical gold or family real estate for decades without a second thought, yet we often expect a stock investment to double our money in a matter of weeks. Most individual investors lose money not because the market is rigged, but because they approach it with the wrong psychological framework, treating a massive engine of wealth like a casino slot machine. To see what happens when you treat the market with the patience of a piece of land, look at the historical trajectory of Wipro. The data is staggering. A 10,000 rupee investment in Wipro 40 years ago compounded into 700 crore today. Even at a smaller scale, just 100 rupees would have grown into nearly 7 crore over that period. These figures aren't a glitch or a stroke of luck. They are the result of letting a small amount of capital grow undisturbed for 4 decades. A share is a fractional legal ownership stake in a real-world business. When you buy one, you are becoming a silent partner in that company's operations. Companies require massive amounts of capital to expand, to build new plants, factories, and complex infrastructure. This scale of funding is often beyond what a single bank can provide. To raise these funds, a company undergoes an initial public offering, or IPO. This is the moment a private business trades pieces of its ownership to the public in exchange for expansion capital. Once a company is public, its daily price fluctuates based on the simple mechanics of supply and demand. These movements reflect the collective confidence people have in that company's future earnings. Investing means aligning yourself with tangible entities like Reliance or Tata, companies that own massive physical assets and drive the actual economy. Ultimately, the stock market is a mechanism designed to finance human enterprise, allowing anyone to share in the profits generated by industrial giants. This process doesn't require a finance degree or a background in commerce to navigate successfully. The 10-year-old children won because they used basic observation. They chose companies whose products they used every day, like the chocolates they ate, the toys they played with, and the movies they watched. They picked businesses they could actually see succeeding in the real world. The chartered accountants, by contrast, often lost themselves in complex spreadsheets and abstract data, overlooking the obvious consumer trends right in front of them. In the market, observational logic and an understanding of human behavior are frequently more effective than advanced mathematical models. Starting doesn't require a fortune. Today, all you need is an Aadhaar card, a PAN card, a bank account, and a Demat account. A Demat account serves as a digital vault. It's where your ownership stakes are recorded and held safely, just as a bank account holds your cash. Consider the long-term impact of a small, consistent habit, investing just 1,000 rupees a month. If you increase that monthly investment by 15% every year and achieve an average annual return of 15% over 25 years, the math begins to accelerate. After 25 years, that small monthly habit grows into a fund worth 1 crore rupees. Looking at the final total, the vast majority of that wealth is generated by the compounding process itself, not your out-of-pocket contributions. Wealth isn't reserved for those who start with millions. It's created by anyone who activates the engine of compound interest and leaves it alone. High-performance investing requires viewing stocks as decades-long business partnerships rather than short-term instruments. While the market involves risk, that risk is primarily managed by ignoring the daily noise and the panic of the trading floor, giving quality businesses the time they need to execute their plans. Before committing capital, invest in your own understanding. Books like Rich Dad, Poor Dad, Learn to Earn, and The Education of a Value Investor provide the necessary mental framework. The massive returns we've seen aren't driven by a single hot stock selection. They are the unavoidable outcome of time and compounding working in tandem.